In today's video, I'm going to be talking about SCHD, one of the most popular dividend ETFs in the world, and to me, it's the best dividend ETF, but some could disagree. Every year, investors eagerly wait for one thing, the annual reconstitution, which takes place in March. This is when SCHD removes companies that no longer meet its investment criteria and replaces them with new holdings that better fit the index. Normally, investors immediately focus on the additions and deletions, who got added, who got removed. And that's important to assess. But a better question could be, did these changes actually make SCHD a better ETF? Because at the end of the day, the goal isn't about making exciting changes. The goal is improving long-term returns for investors. And by now, we are several months into the new look SCHD, and we can see how these changes have played out. We can finally begin answering that question. Today, we're going to compare the new SCHD portfolio against the old one to determine whether this year's reconstitution actually added value. It's going to be a cool video, but before I get into the research, do me a huge favor. Click that like button down below, subscribe to the channel, it helps a ton. And also comment below whether you are an owner or not of SCHD currently. And with that being said, let's jump into today's video. So, what is the SCHD reconstitution? Well, let's first quickly review what happened. Every March, SCHD rebuilds its portfolio using the Dow Jones U.S. Dividend 100 index methodology. The process screens hundreds of dividend-paying companies, meaning if you don't pay a dividend, you're not going to be included for potential inclusion. And they end up selecting approximately 100 holdings based on a number of different factors, from cash flow to debt, return on equity, dividend yield, 5-year dividend growth rate, consistent dividend payment. This isn't an actively managed ETF. It's rules-based. That means companies don't stay forever. The portfolio is chosen every year based on the same criteria with no human interaction. So when I hear some say, why would they add this, or why would they remove that? There is no they. It's an algorithmic process, a set of rules. If fundamentals deteriorate or another company scores better, the portfolio changes automatically. But during that March reconstitution, that's the only time changes can be made. Rebalancing takes place quarterly, but no portfolio changes until March. So before we get into those changes, I want to thank today's video sponsor, which is Kalshi. Kalshi has taken the prediction market by storm in 2026, and if you're unaware, Kalshi is the first CFTC-regulated U.S. exchange to offer prediction trades, also known as perps. Unlike with options, perps do not have expiration dates. Looking here at the app, you can see trades that can be placed on sporting events, politics, crypto, economics, and of course, stocks. So let's look at this trade here as it relates to the stock market, since that's what you're here for. We can see trades that end as soon as tomorrow, or we can look at where the NASDAQ 100 or the S&P 500 will end for the entire year in 2026. It's yet another way to express a view on what's happening in the economy beyond simply buying or selling stocks, which we do love to do. And if you have a strong opinion about where inflation might be headed or what the Fed might do in its next meeting, Kalshi gives you a way to participate based on those outcomes. As always, make sure you perform your own research and understand the risks before using any financial platform. But if you want to try it out right now, using my link below, when you trade $25, you will be entered for a chance to earn up to $500. So make sure you give Kalshi a try today. All right, so now let's get into those changes that were made for SCHD in 2026. This year's reconstitution was much larger than many investors expected. Roughly 24 companies left the portfolio, while about 25 new companies entered. The numbers were exactly 22 leaving, 25 coming in. And some of the biggest additions included the likes of United Health, stock ticker UNH, Abbott Labs, ABT, Procter & Gamble, PG, Qualcomm, QCOM, and Accenture, stock ticker ACN. Meanwhile, several well-known names exited the portfolio. Some of the largest included Cisco Systems, AbbVie, which is a favorite of mine. I was sad to see both of those top two positions leave. Then Valero, Halliburton, and Packaging Corp of America. These were the largest adds and subtractions by weighting, but you can see the entire list here on your screen now. But let's see a chart based on how these stocks performed from March 23 until July 24, so about 4 months exactly. The biggest winner in a big way was UNH, whose shares are up 55% since being added to the portfolio. Followed then by a big move from Qualcomm, whose shares are up over 30%. Procter & Gamble's only up about 3%, and Abbott is flat. The biggest loser in terms of the top 5 additions in a big way was Accenture, whose shares are down more than 20% since its addition to the fund. But overall, a very solid outing from the new additions collectively. Now let's transition to the largest stocks that were removed from SCHD's portfolio and see how they have been doing. Cisco, which was the biggest deletion in terms of weighting, is up 45% since being removed. So that was not great for SCHD shareholders. Valero shares are up nearly 30% since being removed, and AbbVie is up 25% since being removed. And PKG shares, they're up 20%. The only stock in the red of those top 5 that were removed is Halliburton, whose shares are down nearly 15% since being removed from the portfolio. So between the top 5 added and the top 5 removed, I think it's pretty safe to say the deleted stocks are outperforming so far. However, those are just 5 positions on each side, and one of the biggest shifts in this entire reconstitution was actually sector exposure. And before we look at those changes, let me remind you of how the sector performance has been thus far for the entire S&P 500. Energy is at the top with a whopping 33% move higher, followed then by industrials, technology, real estate, materials, and utilities, as the sector's outperforming the greater index. Only consumer discretionary is in the red on the year. So with that being said, SCHD reduced its weighting in energy by 8%, which is proving to not be great considering the energy sector is the leading sector in 2026 by a big margin, while increasing its exposure to healthcare by 4% and technology by 3%. Materials is pretty much gone from the SCHD portfolio as all material stocks were in fact removed. At the time, many investors, though, they question all of these decisions, especially because energy has been one of the strongest performing sectors to date, even leading up to the reconstitution, and now we see it again after. But little did we know a war with Iran was right around the corner from the reconstitution, and it has kept the sector climbing higher. But with all of that being said, now let's answer the important question. Did those changes actually help, or did they hurt? And looking here at this chart, you can see I have downloaded the entire portfolio as of today for SCHD, and the highlighted names in green are the new additions to the portfolio. So let's begin with those additions, and here you can see all of the additions together that were made for 2026, which totaled 25 new stocks being added. And as you can see, they're weighting in the portfolio with the 10 largest new additions accounting for more than 25% of the entire portfolio. And down at the bottom, you can see the average return for all 25 additions was nearly 8%, a very solid return overall. But remember, these are not equal weighted. So the larger companies will have a bigger say in what the overall ETF does and how it performs overall. So when I bring that into the equation, the new additions provided a positive 2% to the fund since reconstitution roughly 4 months ago. And with that being said, now let's move over to the stocks that were actually removed from the portfolio, which you can see on your screen, all 22 of them. These stocks performed better collectively with an average return of nearly 9%, but overall impact was slightly higher at plus 2.3% since reconstitution day. And again, all of these are based on the current weightings, which we just recently, at the end of June, went through a rebalancing. So they're not exact to a degree. But since reconstitution, shares of SCHD as a whole have climbed 9%, and nearly 11% when you look at total return. 4 of the largest weightings in SCHD account for 2/3 of that entire gain that we have seen, with those stocks being made up of 2 new additions in United Health and Qualcomm, and 2 carryovers in the portfolio in Texas Instruments and Altria Group of all stocks. The way I like to look at it is when we look at the stocks with a weighting of more than 1%, because these are the ones that can have meaningful impact on the overall portfolio, the new additions have an average return of 4% in the positive, compared to the deleted stocks with a weighting of more than 1% at the time before being removed. They've returned an average of 15%. This is the biggest outlier right here. And again, the weightings are rebalanced quarterly, but that stat is the most telling sign that SCHD's performance would in fact be higher without the most recent reconstitution. And the figures would be higher without the recent June rebalancing as well. One thing that investors often forget is that SCHD isn't trying to predict the next 3 months. It's trying to build a portfolio capable of outperforming over many years, even though it's changing on an annual basis. That means it occasionally sells companies that recently performed well and buys companies that may not be having a great quarter. In other words, SCHD constantly is trying to improve the quality of the portfolio, not necessarily chasing momentum. This year's changes appear consistent with that philosophy. Fundamentally, the reconstitution modestly improved the portfolio's quality metrics while leaving the overall yield roughly unchanged. Slight changes, I should say. It's impossible to foresee a war that would lead to sky-high oil prices, driving energy sector even higher, and huge moves from the likes of Cisco and Avi, two notable deletions that I commented on during my reconstitution video, two that I wish stayed in the portfolio, but again, we follow a set of rules. It's all a catch-22. So did SCHD make the right changes? Personally, I think the answer is yes. Well, why would you say that? The performance is worse. Because they're simply sticking to a same game plan that they always have. And when you look at the performance of SCHD from a total return perspective, I love what I see. And as investors, even myself doing this full time, do I always time the exact bottom to buy and the exact top to sell? No. But as long as I stick to my strategy, I'm constantly outperforming the S&P 500. And if you want to follow all of my trades, get my market reports, option trades, be sure to join my private investing community, the Stock Investor's Edge. You get access to the private Discord as well. There's a link for that down in the description below. But one of the reasons I've always liked SCHD is that it removes emotion from investing. And emotional investing is constantly a losing strategy. It doesn't chase headlines, it doesn't panic. It simply follows a disciplined methodology. Over long periods of time, that consistency has historically been one of the ETF's biggest strengths. No annual reconstitution will ever be perfect. Some removed companies will inevitably outperform. We're already seeing it. Some new additions will disappoint. We're seeing that as well. That's simply part of investing. The real question is whether the process continues improving the portfolio over decades. And that's exactly why I continue owning SCHD. At the end of the day, I don't judge an ETF based on one quarter performance. I judge it based on whether it consistently follows a disciplined investment process, and we see that performance year in and year out. SCHD's March 2026 reconstitution made meaningful changes. Some have already worked out well. Others will take more time to evaluate. But overall, I believe the changes improved the long-term quality of the portfolio while maintaining exactly what investors have always loved about SCHD, a diversified collection of high-quality dividend-paying stocks. And again, if you enjoyed this video, don't forget to hit that like button, subscribe to the channel, and let me know, do you own SCHD in your portfolio right now or not? Thanks again for watching, and we'll see you next time. Take care.